The top 10% of households in this country own 87% of the stock market, all corporate equities, and mutual fund shares. The bottom half of the country, 1%. That's Federal Reserve data this year. If you've been treating bubbles as anomalies, this is the architecture you've been missing. That's not inequality. That's architecture, and they built it deliberately. By the end of this video, you'll know exactly how the wealthy legally pay zero income tax on the money they spend, why middle-class consumer spending has been structurally weakened for 50 years, not temporarily soft, and why the AI rally isn't a bet on technology. It's the system executing its only remaining function. If you don't understand this architecture, you'll keep treating bubbles like anomalies. You'll buy the momentum, get stopped out by the mandatory unwind, and wonder what you missed. What you missed is that the unwind was never a market risk. It was always a scheduled event. Here's what most people know. A wage earner in the top bracket pays 37% marginal federal rate. Add Medicare taxes, Social Security, and you're giving up about 39 cents of every additional dollar you earn from work. Now capital gains. You hold an asset over a year and sell it. You pay 23.8. That's the 20% long-term rate plus the net investment income surtax. Roughly 60 cents on the wage earner's dollar. Most people hear that and stop right there. But here's what actually happens at the top. You don't sell. Your portfolio appreciates. Say 50 million. You go to the bank. You borrow 20 million against that portfolio as collateral. Banks would lend more, but 40% leaves a buffer, so a bear market can't force a margin call. Borrowed money isn't income. There's no taxable event. None. And yes, the bank charges interest, a point or two above the benchmark rate at this scale. But you don't write a monthly check. The interest just accrues onto the loan balance. As long as the portfolio compounds faster than the loan does, your net worth grows anyway. When rates were near zero, this was almost free money. But even today, it beats handing 23.8% to the IRS upfront. And the loan? You never repay it in life. At death, your estate settles it. And the step-up rule resets the cost basis on everything you own to market value. The gains are erased for tax purposes. Never taxed while you lived. Never taxed when your heirs sell. The estate planning industry has a name for this. Buy, borrow, die. That's the loop. Appreciate, borrow, spend, never sell. And let death delete the tax bill. It's legal. It's permanent. And the capital gains rate is irrelevant to anyone running it because they never trigger it. 23.8% of a taxable event that never happens is still zero. But that's just the tax layer. Same logic runs through the job you do, the products you buy, and the debt you carry. And those layers stack. Your grandfather's refrigerator ran for decades. Today's average lasts years. And when it breaks, the repair quote comes back higher than the replacement cost. That's not a supply chain problem. That's a decision. And the gig economy didn't create flexibility. One classification decision, contractor instead of employee, moved healthcare costs, retirement contributions, and the employer's half of payroll taxes off corporate balance sheets and directly onto individual workers. 3 cost layers in a single move, permanently. Call it what it is, an offload economy. The system extracts through 5 parallel channels simultaneously. Shadow work, labor you now perform free of charge that companies used to pay someone else to do. Self-checkout, insurance navigation, tech support you run yourself. Product degradation, shorter lifespans, repair priced out. Gig risk transfer, your healthcare problem now, not theirs. Debt normalization, credit cards averaging over 21% aren't a trap. They're the product. And fee extraction layered over every transaction in that stack. Each one of those is survivable in isolation. The 5 together aren't. Real wages went from essentially nowhere from 1973 to the mid-2010s. 4 decades flat. And the gains since haven't closed the gap. CEO compensation rose more than 1,000% since the late 1970s. Typical worker pay rose about 25%. The average credit card now charges over 21%. The personal savings rate is running at less than half of its 1970s average. This isn't a cyclical soft patch that recovers in 2 quarters. This is what the structure produces, deliberately, over half a century. Stack that across 130 million households, and here's what you get. The top 10% of earners now account for roughly half of all consumer spending. GDP didn't stop depending on the consumer. It stopped depending on the median consumer. The middle can't carry the growth anymore. The economy needs a replacement engine, not better policy, not a productivity boom, something else entirely. And the system found it. 4 times in 25 years, the same pattern ran. .com in the late 1990s, housing in the mid-2000s, crypto in 2020 through 2022, AI now. Most people look at that list and see 4 separate sectors, 4 different causes, 4 separate regulatory failures. That's not what this is. It's one mechanism running 4 iterations. The bottom 90% can't drive spending growth. We just showed you why. So growth runs through the top 10%, and their spending runs on asset prices. The economy needs asset appreciation to keep the engine running. Wealthy households borrow against gains, they spend. That spending flows into GDP. The economy runs, and everyone calls it a bull market. When the bubble breaks, the gains were already extracted at the top. The Fed socializes the systematic losses through QE, through 0% rates, and punish every saver through bailouts that protect the asset holders. The Fed isn't captured by Wall Street. It's trapped by the structure. The system requires it to reflate, so it does. And when rates hit 0 and new liquidity floods the system, where does it go? Into the next asset class that can hold a narrative long enough to run the mechanism again. Serial bubbles aren't policy errors. They're load-bearing infrastructure. The Fed can't choose not to run them because the alternative is a structural GDP collapse with no replacement engine available. .com, housing, crypto, AI, same mechanism, different ticker, each one mandatory given what came before it. So the question isn't whether there'll be another bubble after this one. There has to be. The only question that matters for you is which bubble is running right now, what's fueling it, and when the forced unwind hits. What does that inflection point look like? The AI rally answers all 3. Apply the framework to what's running right now. NVIDIA's market cap at multi-trillion levels, Microsoft, Amazon, Google, and Meta committing hundreds of billions in annual CapEx, startup valuations driven by GPU access, not revenue. Every precondition for every prior iteration is matched. Here's what this isn't: undisciplined investors who didn't learn from 2000. This is the system executing its only available function. The economy needs this bubble to run long enough and large enough that gains flow to the top 1%, who hold 85% of the assets. That borrowed spending shows up in GDP. That GDP gives the Fed room to claim a soft landing. And when it unwinds, the losses get socialized through the next QE cycle, which immediately begins inflating whatever narrative is next. The AI rally isn't a bet on artificial intelligence changing the world. It's a structural necessity. The system requires it to function. 50 years of structural compression pushed the growth engine away from middle-class spending. The system replaced it with serial, mandatory asset bubbles. Each one concentrated gains at the top, socialized losses through QE, then use the same QE liquidity to inflate the next one. The AI rally is iteration 5. It runs until the system decides enough has been extracted from this cycle. Then it unwinds. The Fed pivots, rates fall, then liquidity finds the next available narrative. The forced unwind isn't a tail risk. It's not a black swan. It's what the mechanism requires to complete its cycle and start the next one. You're not asking whether this unwinds. Structurally, it has to. You're asking when the system decides enough has been extracted from this iteration. That's the inflection. That's where the trade is. And knowing the mechanism tells you exactly what to watch for. You now understand why this system manufactures serial bubbles and why the forced unwind of the AI rally isn't a market risk. It's a structural requirement. But knowing the mechanism that makes this inevitable isn't the same as knowing what price is actually doing right now, or when this story becomes tradable. Here's what understanding that mechanism doesn't give you: the truth about price. It gives you a narrative, and narratives matter. But price is what tells you whether the narrative is true or not. The measured move is a framework for understanding the direction of price. It tells you whether this narrative is being confirmed by price or not. If you act on a story like this without that framework, you could be right about everything you just heard and still be on the wrong side of a trade for days, weeks, or even months. That's the framework that I teach. The traders in my community don't get trapped by bearish narratives. They know where a trend fails, and until it does, until price confirms it, they will trade a bullish trend until it fails, even if it is against a bearish narrative. They have a framework for reading it themselves. That's the process I teach every day at eminiaddict.com.